Last month, I logged into my credit card account. I was not there to shop. I was not there to redeem points. I was there to pay the bill. Before I could tap pay, a friendly pop-up slid onto the screen. Update your annual income, it said. Help us serve you better. My old income was already filled in. A neat little box waited for my new number. Serve me better. That is what the bank claimed. I closed the pop-up without changing a thing. I did that on purpose, because I know why they ask, and it has nothing to do with service. When you tell a bank your income, you are handing them ammunition. You are giving them a number they will use quietly. They will use it to sort you. They will use it to price you. They will use it to sell you more. Those decisions help them first. They do not automatically help you. Every time you refresh that income field, systems start running in the background. Profiles shift in ways you cannot audit. Limits creep in ways you can feel. Offers change in ways you can measure. This is not like updating a shipping address for fun. This is not like confirming your email for a coupon. This is a lever that helps a company model your wallet. They want the number because it sharpens the model. They want the number because it reduces their uncertainty. They want the number because uncertainty is expensive for them. Banks have trained us to treat income questions as normal. They tuck them into applications like a phone number. They dress optional updates like customer care. They make the whole thing feel polite and routine. So most people never stop to ask the obvious question. Why do they want this number? What happens after they get it? The answers can change how you deal with banks forever. My name is Max. I run Max Invests. I make money, mechanics feel human. If this already feels a little too familiar, comment the last time a bank nudged you for income and subscribe to Max Invests. I read comments. They shape what I explain next. Also, a quick grounding note before we go further. I am sharing education, not legal advice. Rules can differ by country, product, and lender. Your paperwork still matters. Your honesty still matters. My point is simpler. Know the difference between required and requested. Know what you are feeding a system when you click. Here is what most people miss. Banks are not automatically required to know your salary in many everyday situations. There is no universal law that says a credit card company must have your latest pay story on file. There is no rule that says you must update a pop-up just because it looks urgent. They ask because they want the data. They want it because it helps them make more money from you. That distinction matters more than people think. When something is legally required, you have to provide it. When something is only requested, you still have choices. Banks blur that line on purpose. Informed customers make choices that sting profits. They will use friendly language to make optional feel obligatory. They will use urgency to make voluntary feel risky. They will use tiny design cues to make skipping feel rude. None of that changes the core math. If you do not have to give it, you can choose not to give it. Think about the last credit card application you saw. It probably asked for annual income. You probably typed a number without thinking. Why would you not? It feels standard. Everyone asks for it, but the moment you hit submit, the issuer is not just checking a box. The system categorizes you instantly. Your income becomes a data point in a profile. That profile decides more than yes or no. It helps decide your rate. It helps decide your limit. It helps decide what offers you see. It helps decide how hard they will push the next product. It can influence how often they nudge you after approval. It can influence whether you get flagged for upgrade paths. It can influence how aggressive cross-sell feels on day one. None of that is printed in big letters on the application. It is the quiet part of the process. Let me walk through the mechanics because the details are useful and a little uncomfortable. Key idea. Limits are not just generosity. Credit limits are the most obvious use of income data. A higher stated income often leads to a higher limit. That can sound reasonable on the surface. Someone earning a lot can theoretically handle more debt than someone earning a little. But a higher limit is not always a gift. A higher limit is also a bigger rope. Banks know people tend to spend toward what is available. A $32,000 limit does not only say you can spend more. it increases the odds that you will spend more. That can mean more balances carried. That can mean more interest paid over time. The bank is not handing you a trophy for success. They are handing you more runway. Some customers use runway wisely, many do not. That is the business model talking. Also notice what a higher limit does to your mental accounting. A higher limit can feel like approval. A higher limit can feel like trust. A higher limit can feel like you made it. That feeling is useful to a lender, even when the math is not useful to you. If you want less temptation, you often want less runway. If you want less runway, you should think twice before feeding income updates that exist mainly to justify more runway. Key idea: rates are not only about risk. Interest rate math is where income data gets sneaky. People assume higher income means lower rates. Sometimes that is true. Often it is not that simple. Issuers blend income with other signals. They estimate risk, sure. They also estimate how price-sensitive you are. Some research suggests higher earners can end up with worse terms when a bank bets they will not shop around. If you make $200,000 a year, you might not chase a slightly better APR. You might not switch providers over a few points. The algorithm notices that kind of inertia. In banking circles, there is a blunt phrase for part of this. Ability to pay pricing. It means you can be charged more because you can afford to pay more, not because you are a bigger default risk. That is not a comforting sentence, it is a useful one. Naming the pattern helps you stop feeling crazy. If you ever feel dumb for paying a higher APR, even when you pay on time, this is one reason the world can feel rigged. It is not always because you are bad with money. Sometimes it is because you look profitable. Sometimes it is because you look busy. Sometimes it is because you look unlikely to leave. Key idea: your income becomes a marketing filter. Marketing and upselling are where income data gets loud. The moment you reveal a high income bracket, you get sorted into a bucket. High earners see premium cards with big annual fees. They see pitches for personal loans and investment products. They see insurance bundles tied to your tier. Every login can feel like an obstacle course of upsells. The bank is not guessing randomly. They calibrate the obstacle course to your bracket. Imagine someone earning around $180,000 a year. Now imagine someone earning around $60,000 a year. The $60,000 household might see fewer luxury offers. The $180,000 household might see a $550 annual fee card presented like a status upgrade. Banks also know a simple truth about fees. Higher earners are more likely to say yes to a pricey card when it is framed as premium. Lower earners face a different flavor of pressure. They might see fewer glittery upgrades. They might see more traps dressed as relief. Balance transfer offers with messy fine print. Personal loans with steep rates. Credit limit increases that make overspending easier. The targeting feels personal because the data is personal. And it is not only what you see on the screen. It can be what hits your mailbox. It can be what hits your email promotions folder. It can be what shows up as pre-approved noise. The income bracket helps the bank decide how hard to squeeze. The income bracket helps the bank decide what story to tell. The income bracket helps the bank decide what fear to use. If you want more videos that translate bank behavior into plain English, subscribe to Max Invests. I drop breakdowns like this every week. Now we go deeper because this part is sneaky in a different way. Income data does not evaporate after you type it. It sits in your file. It can influence decisions you never see coming. It can travel to partners and affiliates under privacy policies most people never read. That income figure you entered years ago can still be influencing how you are treated today. It can factor into limit changes. It can factor into rate changes. It can factor into whether you are kept or cut when the economy gets shaky. Banks have long memories. Your data has a long half-life. Even if your life changed, even if your spending changed, even if your discipline changed, an old income label can stick around in the system. That is why those quick updates feel so persistent. They are not only about accuracy, they are about freshness for prediction. Fresh data makes models feel confident. Stale data makes models feel hungry. So when do you actually have to disclose income? And when is it optional? A mortgage is a different animal. Mortgage underwriting usually requires real verification, pay stubs, tax documents, employment checks. That is tied to rules meant to confirm ability to repay. That is why mortgage mistakes can hurt the whole economy. That is why no income verification stories belong in history books. We want guardrails on the biggest debts. Auto loans can vary by lender and loan size. Some lenders verify hard. Some lenders accept stated numbers more loosely. Credit card applications ask for income, and here is the twist many people do not know. Issuers often do not verify what you type. They cannot see your tax returns without permission. They cannot magically pull pay stubs. They are relying heavily on what you tell them. So ask yourself a blunt question. If they will not pay the cost to verify, why do they still want the number so badly? Those periodic income update pop-ups on your account? Those are optional in the practical sense. You are not legally forced to refresh your life story just because a screen looks official. The bank wants the update. They do not always need the update. The pop-up is designed to feel mandatory. Often it is voluntary theater. Let me be painfully clear about ethics. I am not telling you to lie on an application. Lying about income on credit paperwork is fraud. It is illegal. It is wrong. Do not do it. What I'm saying is different. There is a gap between fraud and privacy. Fraud is misrepresenting facts to get something you should not get. Privacy is refusing to volunteer extra data that will be used against your interests. When a bank asks you to update income mid-relationship, you can often close the window. You can leave fields blank when the system allows it. You can decline to hand over numbers that are not required. That is not deception. That is boundaries. If you are ever unsure what is required, pause and read the actual terms. Pause and ask what the application is for. Pause and ask what happens if you skip. If skipping does not break a law, it does not make you a bad person. It makes you a careful person. Consider the asymmetry for a second. Your bank already sees a lot about you. They see spending patterns. They see payment history. They see debt loads. They see habits. They run models you will never fully inspect. Meanwhile, you do not see their internal rules. You do not see the full scoring recipe. Refusing to volunteer fresh income does not fix everything. It does reduce the information gap a little. They still observe your behavior. They still have plenty of data. They just have less of the one number they want most. You are not hiding from reality. You are refusing to volunteer extra reality to a system that will monetize it. That is a different mindset. It is a calmer mindset. It is also a more honest mindset about incentives. Picture two customers with identical credit behavior. Same scores, same utilization, same on-time streak. One customer updates income every time the bank asks. Their income climbs from about $70,000 to about $95,000 over a few years. The other customer never updates after the original application. The first customer starts getting louder marketing. Their limit goes up without them asking. They get groomed for premium products because the model sees rising income and rising opportunity. The second customer gets calmer treatment. Their limit stays steadier. They fly a little more under the radar because the bank has a less fresh income signal to exploit. Which customer is better served? It depends what you want. If you want maximum access and you like aggressive offers, updating everything might match your style. If you want peace, fewer pitches, and stable terms, you might prefer less income disclosure over time. This is not about shame either direction. It is about matching your goals. Some people want more credit access on purpose. They want the big limit for a planned strategy. They should know what they are opting into. Some people want fewer temptations. They are trying to protect their future self. They should know what they are opting out of. Stress seasons add another layer. When the economy weakens, banks review portfolios. Limits get cut. Accounts get closed. Rates get bumped. Those decisions are often algorithmic. Income data feeds into those models in messy ways. Sometimes high income helps you look safer. Sometimes high income makes you a target for worse pricing because the model assumes you will absorb it. Sometimes lower income makes you look riskier in a downturn, even if your behavior has been perfect. The only clean move is not moralizing. The clean move is data discipline. The less they can sort you with stated income, the more they lean on what is harder to fake. Payment history, utilization, account age. Behavior is not perfect. Behavior is often more honest than a typed number. This is why I care about the optional update pop-ups so much. They look small. They are not small. They are a scheduled refresh for a machine that wants to sell you more precisely. If you want to be sorted less, give them fewer fresh sorting labels. I have a friend who does contract work. Some months she clears about $8,000. Some months she clears about $15,000. It depends on project load. When she applied for a card, she reported income conservatively. She used a lower month as her baseline. That was honest and careful. 2 years later, she wanted a limit increase. The bank asked her to update income to process it. She typed her real higher range. Within a few months, her phone started ringing. Personal loan pitches showed up constantly, her mailbox filled with balance transfer teasers. Her offers tilted toward high annual fee cards. She had been reclassified. Her quiet banking life turned into a sales campaign. She stopped updating after that. When pop-ups appeared, she closed them. Her experience cooled down in about 6 months as the fresh income signal faded. Her profile drifted back toward default treatment. That story is not magic. It is how fresh data wakes the machine up. Stale income is less useful for prediction. Banks push updates because updates reset the clock. Every refresh makes you a bright target again. There are still legit reasons to update sometimes. If you truly want a higher limit and your income is materially higher, sharing can support your case. If you are applying for a loan where verification helps you, disclosure can serve you. The keyword is intentionality. Update when it helps your goal. Skip updates when it mostly helps their model. If you are building a business, sometimes you want a relationship banker in your corner. If you are trying to simplify your life, sometimes you want fewer products, not more prestige. If you are paying down debt aggressively, sometimes you want fewer triggers, not bigger limits. Your strategy should drive the disclosure, not the pop-up's guilt trip. Also think about lifetime value the way a bank does. They estimate how much profit they can extract over years. Higher income suggests higher lifetime value. That can justify more aggressive tactics. If you withhold precision, you introduce uncertainty into their spreadsheet. Uncertainty often leads to more conservative treatment. That can be good for you. There is a psychological layer too. Forms feel official. Pop-ups feel urgent. Skipping them can feel like you broke a rule. Your brain wants to cooperate. Your brain wants to be a good customer. Your brain wants to avoid friction. Banks know that. Friction is not always accidental. Sometimes friction is a filter. Sometimes friction is a sales funnel. Sometimes friction is a data funnel. The first time you close an income update without complying, you might feel a flicker of guilt. Nothing bad happens. Your account still works. Your score does not change just because you refused a pop-up. They will ask again in a few months. You can close it again. Over time, you realize how much of banking UX is theater. The authority is partly costume. The request is partly habit. You always had choices. The bank just preferred you did not notice. Let me give you a simple playbook. For new credit card applications, you will usually need to provide income information. Be accurate, but do not volunteer extra detail you do not need. If you are self-employed, you might use a conservative annual estimate. If you have side income, you might decide what belongs in the box and what belongs in your private notes. If you are a W-2 employee with steady pay, your story is simpler, but the principle is the same. Do not confuse honesty with oversharing. If your income swings month to month, you do not have to use your best month as your whole story. If your income has multiple parts, you do not have to list every dollar you ever touched. Stay within honest bounds, but stop treating the form like a confessional. For income update prompts on existing accounts, my default is ignore unless I want something specific that truly requires verification. There is no prize for feeding the machine on schedule. The prompts will come back. You can keep closing them. For credit limit increase offers, decide if you actually want a higher limit. If you do not want more rope, you do not need to hand over fresh income data to enable a limit bump you never needed. For loans where verification is truly required, provide what is required. If they ask for paperwork beyond what makes sense, ask why before you comply. For phone calls that pressure you to confirm details, remember pressure is a design choice. You can decline, you can keep the call short. Your accounts can remain open without your life story. If someone says it is for security, ask what exact risk they are preventing. If someone says it is for your benefit, ask what benefit is locked behind the update. If the answers feel fuzzy, you are allowed to keep your number private. This principle goes beyond banks. Any institution asking for your data is usually optimizing their outcome first. They will frame it as service, they will frame it as accuracy, they will frame it as convenience. Underneath is extraction. Data minimization is a real strategy. Give what is required. Decline what is optional. Understand what you are trading away. Banks are not cartoon villains. They provide real tools people need. Credit can be useful. Loans can be useful. Accounts can be useful. They are also profit-seeking companies. Customer data is a resource to them. Seeing that clearly is not cynicism. It is adulthood. So the next time that income update pops up, you will know what is happening. They want fresh ammunition for models that optimize their profit, not your peace. If it does not serve your plan, close the pop-up. Let your payment history talk. Let your behavior talk. That is the data they cannot collect just because they asked nicely. If this video helped you see the game, subscribe to Max Invest for more plain English finance. Leave a comment and tell me the truth. Do you update income when banks ask, or do you ignore it, and what changed your mind?